I think I know what you're talking about. When I drew the, I think it took my lines off. So I put them back on there again, and no biggie. Let's remove this. I'm gonna go back and do this again real quick. So draw this trend line here. Boom. Come here. There's a couple things you can do. I'm gonna give you a couple things that's possible here. Now, so we can see we came here, broke up, gave us our little bull flag, right? That's what I call a bull flag. Got something like this is your little bull flag. Here's your pole, right? To your high. And then we got our chop in here. There are a couple things you can do. There are a lot of things you can do if you're bullish, right? And you gotta you so you first of all, how I if I buy an option, if I buy an option, where's your resistance level? Like where would you say you think that the market could get to if it breaks out of here? So what are our next levels? This is a gap right here. So that's probably why we got the chop here. So maybe this level right here could be resistance. So I'm gonna give you a couple things that you could do depending on what kind of trader you are, right? So that's right around 366. So I would come if I was gonna buy a call, which I'm not. I would come around with 366. We're at 355 right now. So that's an $11 move. I would come on this chain and find out where an $11 move is right here. 12 days, 12. I mean, yeah, that's 12 days, $10.91. 14 days, $12.39. Look at this option chain right here. It's going all the way to what, 368? So that will put you what? Right in here. So if I was, and here's your 200 SMA. Now we're on the intraday chart. Now we're on the hourly. So I will come in here and right around this range, and I probably would come down here and find this 366 and buy this call. I got a 51% chance of probability of touch. This is touch, and you just need to touch it. So what would happen is if I'm buying out here out of the money and it moves in the money, depending on how long it takes. If it did it today, I could pay $225 and make 700. That's just one example of a trade, right? Something else you could do. If it's something is in a range and you think that it's gonna bust out of that range, right? There's something that you can do. You can call It's called a straddle. You can buy the straddle. When you're buying the straddle, you could come. I would not. I don't like. I'm showing you different trades, but you got to use discretion. When you buy options, when the vol is high, you're gonna and the market goes up, you could lose money and you could be right directionally and still lose money because of vol crush. So that's why I'm just showing you different trades. And then I'll show you probably what I would do. But I'm gonna show you I give you all the tools that you can do. And then you gotta kind of like, experiment with what you think is best for your style of trading. So you could do something called buying the straddle. Buying the straddle. Let's go back to this same option chain, and because you might be better at technical analysis than I am, so I will show you the trade. When you want to buy the straddle, there are a couple ways to do it on the Tasty Trade platform. You could come up here. You can, and also, guys, if you want to use Tasty Trade, it's a link. It'll be a link in the show notes. You can use my little affiliate link. So you can come up here, hit this arrow, come down, and you can see it got different trades on here. You see where it says straddle, long. If you want to buy, you hit go, and then there it goes. It puts the trade on there for you. Now I'm gonna lock it. When you buy options or you buy this straddle, it's telling you at the bottom your max loss is basically what you pay for it because you're gonna pay $1,278 for it, right? Now, what you're doing when you buy the straddle is you are betting that the market is gonna exceed the expected move. That it's coiling up and then it's gonna boom. It's non-direct. You don't care what direction. It's either gonna break out to the upside. Now I'm going down the chain because that's how the option chain is, or it's gonna break out to the other side. So you can buy it because you're betting that it's gonna exceed this move right here. That's one trade. That's one type. You can bet on that, or you can buy the call like I showed you, or what I would do, and it takes a lot of patience to do these types of trades, but they're in my opinion is better in this particular instance because we have high implied volatility. The VIX is up, so vol is up. When the VIX is up and volatility is high, that means the price of options, excuse me, expand. They get more expensive. So it's kind of like this. When would you want if I don't want to use that example because we just had that incident in Hawaii, but it's relevant to what I'm saying. What would you want to do with insurance, right? Would you rather be the buyer of insurance or would you rather sell the insurance when the flood, let's just say a house is flooding, you know a zone is getting ready to flood, or the flood is already occurred in this particular area. You'd rather sell the insurance. Why? Because insurance premiums are going up. The event is here and people have to have the insurance. So you'd rather sell it. It's the same idea with options. Like we already got a sell off. The time to have bought those options when you wanted to buy them was before the sell off. So we've had the sell off and you don't generally want to buy options when they're expensive. You'd rather sell them. So what I would do, either I'm going to pick a side, right? And sell, either if I think it's going up, I'm selling puts or put spreads, betting that it's going to go here. Or if I think it's going to continue to go down, which it looks like you see it, I'm going to sell a call spread or sell calls here. Now you can buy puts or calls. You buy a put, you're betting on the market going down. You buy a call, you're betting on it going up. But if you sell a put, you're selling options. You're taking a bet that the market is going to go up, or that it's going to stay where it's at. Because you don't necessarily, excuse me, when you sell options, you don't have to have the market go where you want it to go. It can just stay in a range. And over time, you're going to get time decay, and then you're going to get volatility decay. And so the market, let's just say you came, uh, let's just let's just go. Let's say you came somewhere down here and sold like the 24 delta, right? We'll lock that. You collect in $428 in premium, and you got a 81% probability of profit, and you got an 87% probability of making 50% of this. Meaning that you just want to, once it decays down to 214, you buy it back and take it $200 and keep it moving. And you can see where your break even is on here, right? Your break even is way back here because you at 336, you taking in $4.28 in premium. So what that does is that premium pushes your break even back around 332, which is why this area is gray. And you don't lose money until it gets down here in this red area or up here. So, and then now buying power, it is going to margin you $5,158 of margin or buying power. And so you may say, well, man, that's too much. My account's not big enough for that. Then that's when you do the spread. So instead of staying right there, you can come right here and maybe make it a $10 wide spread. Buy this. They call it, when you do this, that's you're buying the wings. Like when you're doing like butterfly spreads, even when this is a wing. So when I hit this to buy it, that's going to cap my loss. Now I got a fix. Now it's a fixed spread. It's a fix. I can't lose. People be like, even though I don't think the QQQ gonna go to zero, you see how my buying power is only $840 now. I actually would come closer if I'm gonna do a spread like that, so I can make more money. So I do something like that, and so there you go. If you buy that wing, that'll cap it, and so that's the kind of trade that I'll though something like that. If you're good at picking targets, like let's say you think like it's really gonna go right here and target, you can do you can do a butterfly or a broken wing butterfly. Maybe you can buy a call spread. I just don't like buying options when vol is high, but you could buy a call spread 14 days out. You think it's gonna get over here? You really think you'll get there in 2 weeks? Um, buy the 355, sell the 357. That's a call spread. Or you can put the spread out there, spend less, buy the 364, sell the 366. You're only paying 65 cents for it, or $65, and you can make 135. So this is one of those trades. This is more like I'm gonna risk one to make two type deal right here. This is what kind of trade that is. The one I'm selling is where I think the market will get to, and I'm buying the 364. So low probability trade. You can see down here, of pop is 31%. But if your technical analysis is right on, then you jam up with it. That's type of trade you can do. But I don't advise buying options when they're expensive. Yeah, you get good at selling them. Learn how to sell them. And then you get to the point where you don't care about direction. You just say, make the market beat you. You just start selling the expected move.